For most of the modern financial era, gold was treated as something already decided. Its role was considered settled, its relevance categorized, its future bounded. It sat quietly in central bank vaults, mentioned in footnotes, referenced in balance sheets, but rarely interrogated as a living system. The assumption was simple and widely shared. Gold was no longer money in motion. It was an artifact, a reserve, a hedge, useful but passive. That assumption shaped policy, pricing, and power. The London Bullion Market Association became the symbolic center of that understanding. Not because London held the most gold, but because London held the rules. The LBMA did not need to control metal. It controlled reference. It was where price became official, where contracts netted, where settlement was assumed rather than demanded. The market trusted the system because the system had never been tested at scale. For decades, this arrangement worked because no one with sufficient size, patience, or strategic incentive chose to break it. Until now. What makes this moment different is not an announcement or a press release. It is the quiet disappearance of necessity. Russia and China did not storm the system. They simply stopped participating in it as a center of gravity. And when actors of that scale withdraw function, not symbolism, the architecture begins to reveal what it actually is. Most commentary misses this point entirely. Headlines frame the story as confrontation, retaliation, or politics. They look for sanctions, bans, or declarations. They expect disruption to arrive loudly. That expectation itself is a legacy of the Western system, where power moves are performative and legitimacy is broadcast. But monetary power does not behave that way. The real signal was not a statement. It was a pattern. Gold that moved east did not return. Settlement that once referenced London no longer did. Contracts that once cleared through familiar channels began clearing elsewhere, quietly, bilaterally, without dispute. Nothing broke. Nothing failed. The system simply became less necessary. This is the kind of change that never trends on social media because it does not feel dramatic. Yet it is the kind of change that rewrites outcomes years later, when reversal is no longer possible. For decades, the LBMA system depended on one core belief: that gold markets could function indefinitely without widespread physical settlement. That claims could circulate faster than metal. That liquidity itself was stability. And that central banks, even those outside the Western Alliance, would continue to treat London pricing as neutral and authoritative. That belief is no longer shared. What has changed is not ideology, but incentive structure. Russia and China are no longer optimizing for integration into a system they do not control. They are optimizing for survivability inside a system they are building. That distinction explains everything that follows. This shift did not happen overnight. It began years ago, buried in trade agreements, reserve accumulation patterns, and settlement language that most observers dismissed as symbolic. It accelerated when sanctions transformed access risk into a measurable variable. And it solidified when bilateral trade volumes reached a scale where alternatives were not only possible, but rational. At that point, gold stopped being a hedge and started becoming infrastructure. That is the piece most people missed. Gold is no longer being treated as something to be priced and traded. It is being treated as something to be used, not for speculation, but for settlement, anchoring, and trust between counterparties who no longer assume neutrality from Western systems. Once that happens, the LBMA's role changes fundamentally. Not because it collapses, but because its output becomes optional. And in monetary systems, optionality is the beginning of irrelevance. This is not a story about the end of a market. Markets adapt. This is a story about the end of a pricing monopoly that depended on participation from actors who no longer benefit from maintaining it. When that kind of shift occurs, it does not announce itself as revolution. It appears as efficiency, as preference, as internal settlement arrangements. And by the time the broader system notices, the leverage has already moved. What follows is not speculation. It is structure. The LBMA is not an exchange in the traditional sense. It is a clearing and pricing consortium built around unallocated gold accounts. These accounts represent claims on pooled metal rather than ownership of specific bars. This distinction is not cosmetic. It is foundational. Under this system, the vast majority of trades never result in physical delivery. Instead, obligations are netted among bullion banks, with only residual imbalances settled physically. The efficiency of the system depends on low delivery demand relative to paper volume. At peak, the leverage ratio between paper claims and physical gold routinely exceeded 80-1, and in certain derivative segments, far more. This is not fraud. It is design. Component 1. Unallocated accounts. These accounts function like bank deposits, not safety boxes. The holder has a claim, not a bar. The system assumes that most holders will never ask for delivery simultaneously. Component 2. Net settlement mechanism. Daily clearing reduces gross obligations into manageable physical flows. This allows trillions in notional exposure to clear with minimal vault movement. Component 3. Price discovery via derivatives. COMEX futures and LBMA forwards interact to establish a global reference price. The marginal trade, not physical supply, sets the price. Component 4. Central bank tolerance. Non-Western central banks historically accepted this pricing regime, leasing gold into the system and marking reserves accordingly. That tolerance is gone. The system fails when gold stops circulating. Russia and China did not need to drain Western vaults aggressively. They imposed a more damaging constraint, non-reentry. Gold accumulated domestically is not leased back. It is not swapped. It is not mobilized. Once gold becomes static, leverage collapses. Global mine supply averages 3,000 tons annually. Recycling adds 200 tons. Total flow, 200 tons. China and Russia together have absorbed an estimated 700 to 1,000 tons annually when accounting for official and unofficial channels. That alone consumes up to 25% of global supply. Now factor in gold-backed trade settlement. A $50 billion trade corridor anchored at 30% gold collateralization requires $15 billion in metal, roughly 190 tons at current prices. This is not speculative demand. It is structural lockup. The Western system prioritizes velocity and leverage. Collateral is reused. Assets are rehypothecated. Stability is achieved through liquidity. The Eurasian system prioritizes containment and finality. Collateral is immobilized. Settlement is physical or near physical. Stability is achieved through scarcity. These systems cannot converge. As more trade settles outside Western clearing, demand for paper gold diminishes. Delivery premiums rise. Arbitrage breaks. At that point, LBMA pricing becomes informational, not functional. The system does not collapse. It is bypassed. At this stage, the question is no longer whether the system has changed. That question belongs to the past. The relevant question now is timing, because monetary systems do not announce their transitions when they begin, only when they are already complete. What matters is not ideology or even intention. What matters is sequence. For decades, the Western financial system operated under a single, stabilizing assumption that settlement would remain abstract, that obligations could roll forward indefinitely, that claims could circulate faster than assets, that trust, once established, could substitute for delivery. That assumption is now time-bound. Between late 2025 and mid-2026, the global system enters a phase where several independent pressures converge into a single constraint. This is not speculation. It is visible in refinancing calendars, reserve flows, vault inventories, and settlement language embedded deep inside trade agreements that rarely make headlines. First, Western sovereign debt enters a dense rollover window. Trillions in obligations must be refinanced at yields that are politically unpalatable and fiscally destabilizing. Central banks are forced into a narrow corridor. Either suppress yields through balance sheet expansion or allow rates to rise and destabilize fiscal structures. Both paths erode confidence in paper collateral. Second, physical gold availability tightens further, not because supply collapses, but because circulation does. Gold that has moved into Eurasian systems does not re-enter Western liquidity pools. It is immobilized by design. It does not lease. It does not swap. It does not appear in clearing statistics. It simply disappears from circulation. Third, non-Western settlement infrastructure reaches maturity. Trade corridors that once relied on Western intermediaries now clear independently, with gold functioning not as a traded asset, but as a balance sheet anchor. At that point, the system no longer requires Western reference pricing to function. These three conditions intersect once. That intersection is the trigger. It will not arrive with an announcement titled "The End of the LBMA." Instead, it will appear as a technical footnote. A large commodity contract settled outside Western clearing, with gold-linked collateral, at scale, without dispute, without delay, and without reference to London pricing. When this happens, the reaction is immediate, not emotionally, but mechanically. Delivery premiums widen. Paper claims begin to trade at a discount to physical settlement. Vault audits become more frequent. Counterparties ask different questions. Liquidity thins, not because of panic, but because of preference shift. The most important change is subtle. Gold pricing stops being the center of gravity. Settlement does. Once settlement becomes the priority, leverage becomes a liability. Instruments designed around rollover fail to roll smoothly. Assets whose value depends on constant refinancing encounter friction. What once felt liquid becomes conditional. For those unprepared, this moment feels sudden. Not because it is fast, but because it is irreversible. Once counterparties experience settlement without exposure, delivery without dependency, they do not voluntarily return to abstract claims. This is how systems end, not through collapse, but through abandonment. What becomes useless in this phase is anything that depends on trust without custody. Unallocated claims. Excess leverage. Paper instruments whose settlement assumptions were never tested under constraint. These do not fail immediately. They simply lose priority. And in financial systems, loss of priority is fatal over time. What becomes valuable is not speculative yield, but finality. Assets that clear without permission. Assets that settle without intermediaries. Assets that function across systems, not within them. This does not require mass participation. It requires only enough volume to establish precedent. Once precedent exists, behavior changes quietly but permanently. There will be no moment where headlines declare a new order. By the time a language changes, the structure already has. This is why timing matters now. Not because the transition is fragile, but because positioning occurs before recognition, not after. Once the system is widely acknowledged, options narrow. Liquidity concentrates. Access stratifies. Those who wait for confirmation discover that confirmation arrives too late to act. This is not fear. It is intelligence. Every monetary transition in history followed the same pattern. The Roman denarius did not disappear overnight. The silver standard did not end with a proclamation. Bretton Woods did not collapse when Nixon spoke. It collapsed when redemption stopped working. In every case, the mistake was believing that the visible event was the cause, rather than the consequence. What is unfolding now follows the same logic. The LBMA is not dead. It is simply no longer central to the system that matters most. It continues to function for those who still need it. But systems do not require universal participation to dominate outcomes. They require only critical mass. That mass has been reached. When historians look back, they will not mark this transition by a date or a declaration. They will mark it by flows, by when gold stopped returning, when settlements stopped referencing London, when trade stopped needing permission. And once those conditions are met, reversal is no longer an option. This is why preparation is not panic. It is pattern recognition. It is understanding that systems change first in silence, then in structure, and only lastly in language. By the time language shifts, the window has closed. Those who understand this moment are not waiting for collapse. They are adjusting to replacement. They are not reacting emotionally. They are responding strategically. Because monetary history is not written by those who predict loudly. It is written by those who recognize when the rules have already changed. And once you see that, truly see it, the system you thought you were in is no longer the one that matters. Nothing dramatic happens next. Something final does.